Good to see that we're still attracting some interest, but run us through what you've made of the performance of the market here to date.
Hi, Alishia. Yes, we've had a very interesting year to date, and I've had a quick look at some of the numbers earlier this morning, seeing that we're getting close to the end of the year. And there's some interesting themes that emerged for me from the story if I look at the performance of our shares and our sectors year to date. On the positive side, what I find very interesting is that the top performing shares in our market all have a theme of rand hedge shares. Now, this comes despite the fact that we've had relative strength in the domestic currency. And it just shows to me that the fundamentals of these companies actually pull them through beyond whatever the currency actually did. I think we're so used to think in terms of our equity market as being driven by the foreign investors and what their views are and what the currency is doing, that we sometimes underestimate the full value of the fundamentals of these companies that are very good. The top performing top 40 share year to date was Naspers. We've also got Old Mutual in there that did very, very well year to date. We've also got the likes of Steinhoff and Lonmin and Kumba Iron Ore, the top performing resources stock year to date. And a bit later on we can maybe talk about Kumba and its position of whether it really is a resources stock or not. But on the negative side, if I look at the performance year to date, another very interesting theme that emerged from there is that most of our worst performing stocks year to date have been the ones that have been that have had rights issues in them. So I see the likes of Liberty International. They had 2 rights issues, Sappi, Growth Point. These are just 3 of the worst performing shares that we've had in our market year to date, and the investors clearly showing that they are not happy with these companies coming to market at a time where they're certainly not looking for additional shares, so the appetite not being very good.
Nerina, with all that you've, sorry to interrupt there, but with all that you've actually shared with us there, it's industrial stocks that really seem to be standing in the spotlight here, and I think important to highlight that what we're looking at in South Africa is, despite the weakness we're seeing on the consumer side of things, a lot of these stocks that are ranking and standing in the spotlight are those that are globalized.
Absolutely. I think it's a very valid point that you are making. We tend to focus on the consumer and the consumer that are certainly taking a lot of strain in the current market conditions. But we tend to forget that despite the fact that both the consumer and the manufacturing sector are suffering under the strong rand and the weak consumer situation, as you rightly point out, it is the sectors of industrial nature that actually performed the best so far this year. And some of the best performances out of there actually came from the healthcare sector, certainly boosted by the likes of Aspen and Cipla MedPro, beneficiaries, of course, of a stronger rand, because so much of their raw materials are imported, and therefore they certainly had the benefit in terms of their cost inputs being lower because of the stronger rand. But certainly a very good performance generally by our industrial companies, especially those that have been able to globalize.
You mentioned healthcare, but technology shares also seeing some recovery. Dimension Data, Die Data, really seeing some recovery over the past year.
Yes, I think it's a great compliment to companies of the likes of Die Data and Data Tech, companies that certainly operate on the world stage but are proudly South African in their makeup, that despite the world economic conditions and the strong currency, that they actually end up being some of the top performing companies on our bourse over the last 12 months. So certainly kudos to them.
Well, we've seen this quarterly review of the indices. Let's look at Kumba. You mentioned it earlier, reclassified in terms of its sector classification, grouping it now in the industrial space, right?
Yes, quite an interesting one that came out there. It was a very quiet quarterly review. The meeting was held yesterday. This is both the quarterly and the annual index review of the FTSE JSE Africa Index series. They announced the results of that this morning, and as we expected, there are no changes announced to the major derivative indices. So the likes of the top 40, the RESI 20, the Indy 25, the FINI 15 index, all of those no changes. But what surprised us was to see that, as you rightly say, Kumba has now been reclassified classified from a general mining stock to within the subsector called iron and steel, which forms part of the industrial metals and mining sector. Now, according to this fairly unique South African classification of resources, financials and industrials, that places Kumba in the industrial space rather than the resources space. So as a result, we would have expected Kumba to have been excluded from the RESI 20 derivative index and rather included in the Indy 25, and that was not announced. So we're waiting more news from the JSE around this, but an interesting development in Kumba. I must just maybe add that I think despite what this pedantic sector classification is all about, I doubt very much that the investor out there will start to think of Kumba as anything other than a resources company.
Yep, it will certainly be hard to break that classification. Let's look at an index that doesn't ordinarily get attention. I mean, the Dividend Plus Index and how constituents are actually placed within that index. It's very interesting because it's not made up of who's weighted highest. It's dependent on highest forward dividend yield.
Absolutely. It's a very interesting index. It was certainly the first of the so-called fundamental indices that we had in our market. And as you rightly point out, constituents not only selected not on the basis of their size, but also not weighted in the index on the basis of their size. It's an index that is made up of the top 30 stocks within the top 40 and mid-cap space, not inside the real estate sector, so they exclude real estate stocks, and they then pick the top 30 on a forward dividend yield basis. The idea of this index really is that it's supposed to be attractive to investors who are looking for enhanced yield attraction over and above what you might find in the real estate sector. So an interesting one for us there, they only review this index twice a year, so it's done in June and in December, and we saw 5 changes to index constituents. Now, for me, this is an interesting one to observe because when you look at a dividend yield of a company's dividend yield when it changes can be a result of 2 factors. Bear in mind that a dividend yield is a ratio. So it can either be an improvement in dividend yield is either because the expectation or the forward dividend of the company has improved, or it can be because the price declined. And I want to highlight 2 of the new entrants to highlight this point in particular. Oceana is one of the new entrants, and in the case of Oceana, certainly a case of improvement in dividend expectations. A year ago, there was no dividend forecast for Oceana. It wasn't an expectation that they would be paying dividends. Whereas now we do have an expectation of dividends out of Oceana, and as a result brings it into the index. Murray and Roberts, on the other hand, actually had quite a torrid year price-wise, and they've had at best the same or deteriorating dividend expectations. But the price performance was so poor that on a dividend yield basis, it now is at a higher dividend yield than many of our other good dividend-paying companies. So one must be careful when you look at this Dividend Plus Index that you must just bear in mind that sometimes companies can actually end up in this index maybe for the wrong reasons.
Yep.